What's going on, everybody? It's Josh here with Zero Gravity. I just wanted to make a quick video going over some of the ideas and thoughts behind what's going on with AMC right now. So I put together a little slideshow, just kind of break it down in the simplest forms for you, so you can kind of understand, if you don't already, of what's going on. And also at the very end, I got 3 tips for you if you wanted to pull something like this off and make it the most successful as it can be. All I ask is that you hit the like button so as many people as possible can see this. And if you're not already subscribed, please do so. I love bringing content like this, and I'd love to be able to speak to you more. So first off here, we got the hedgy versus retail. That's kind of the concept that's out there right now, what everybody's thinking. So in this example right here, I'm going to use stock ABC, for example. And right here, we have Mr. Joe Retail, just your everyday retail investor. And then on this side over here, we have Mr. Hedgy, or Joe Hedgy, we'll call him, in the form of a pig there. In stock ABC, the total shares available is 10,000. So this company is a small company, right? They have 10,000 shares on the open market. It's currently trading at $10. When you look at the options for stock ABC, you see that the calls for 2 weeks out, you have the $12 call, it's selling for about 225 bucks. You have a $14 call selling for about 175. You have a $16 call currently selling at about $100, right? So we got Joe Retail over here who thinks stock ABC is going to go up. So whenever Joe Retail starts buying calls, the price of the calls go up, right? Now you have Mr. Joe Hedgy over here, and he's looking at this, but he's looking at it in the form of tendies, right? He's thinking, hey, you know, this $10 stock, I'm selling, you know, almost 40% out of the money is $175 expiring 2 weeks from now. That sounds like easy payday, right? Just a quick, easy buck. And of course, Hedgy loves money. Money's food to him. He loves tendies. Let's say in this example, he loves tendies. He'll eat all the tendies he can get. So with this particular stock, we'll say on this one, it's 50% is owned by either institutional or the company itself. Now, with most stocks out there, it varies. Some are, you know, as low as 5%, larger companies, and some all the way up as closer to, you know, the 50, 60 range. But in this particular one, we're going to say it has a 50% float. So that means on the open market available to be traded, there's about 5,000 shares. So Mr. Hedgy jumped in and he sold 20 calls at the $14 strikes and collected a premium of 2,450 bucks. This is, I'm using small examples, of course. Stay with me on that. This would be considered 2,000 shares short. Selling calls is a bearish position. And also, if it's uncovered calls, which majority of the times are with hedgies, they're going to be uncovered, so it's considered a short interest. So in this particular scenario here, selling 20 calls at the $14 strike is going to be a bearish position, and it's going to give the overall stock a 20% short interest. So that means there's 2,000 shares shorted out of the $10,000 available, or the 10,000 shares available. So throughout the next week or so, the stock, you know, bounces around, continues to go up. Now, the reason I drew this is because you'll kind of compare it to the quadruple witching day with AMC. They had sold the $14 strike, and of course, the stock continues to kind of rally. There's maybe some good sentiment in the market. You know, Joe Retail thinks it's a good stock, it's a good investment, it's worthy, and the stock gets closer to that $14 mark. Now, Mr. Hedgy here, he's getting big, right? He loves eating tendies. So what he decides to do is, hey, I'm going to short the stock. So he dumps 2,000 shares as he gets close to 14, pushing it back down. It triggers a few stop losses, a few other people sell. It starts coming back down close to 10. Joe Retail is like, hey, this is still a good deal. It starts buying it back up again. Gets closer to 14. What does Hedgy do? Throws another 2,000 at it. Dumps it back down again. And then guess what? Great news comes out on ABC. All of a sudden, they're opening all their retail locations across the country. Joe Retail, you know, claps and applauds in greatness, and all of a sudden starts buying in like crazy, and the stock continues to go up. Now, at this point, Mr. Hedgy here, he's short the 4,000 shares that he just shoveled in there, trying to keep the stock below the 14 to protect his call options that he sold. And he also still has those $20 calls at the $14 strike, or the 20 calls at the $14 strike that he had previously sold. Now, the 2 weeks has passed now, and at the close on that Friday, the stock was at $16 for this example. Now, immediately after the close, the broker will immediately give Joe Retail those shares. So they issue out those 2,000 shares at $14 to Joe Retail. Now, Joe Retail's happy, is excited, but immediately the broker is going to request those 2,000 shares back from Hedgie. And Hedgie hasn't owned any shares at all. He's just sitting there hanging out still. So he's got to buy those shares at this point. Now, with myself or you, if you're on a marginal account or anything like that, generally they're going to give you about 5 days or so to cover any call options that you sell. So you have about a week to buy those positions back. So you'll be short 1,000, whatever. In this position, he's short 2,000. He has to buy 2,000 shares back within the next 5 days. And he also still has the 4,000 shares that he already previously shorted. Now, since he's in a short position in that, the time frame is considerably longer, and also he'll be allowed a little leadway with that, a little bit more than he is with the options sold. That's what I said. Usually it's a small window for the options. For the actual short, you can hold that position for as long as possible until your account starts getting margin or equity calls. So that following Monday, Mr. Hedgie has to come up with those calls. Right now, the market's trading at $16 still on Monday. So Hedgie starts to buy those 2,000 shares back to cover his sold calls, which is going to drive the market up, especially on a low float as such as this. Now he's got to overall buy 6,000 shares back, and there's only a float of 5,000 shares, meaning that he's going to have to buy some of those shares multiple times. So he's going to buy it and then immediately sell it to somebody else, or sell it to somebody else immediately, and then continue to do that multiple times on the same stock sometimes. So people are going to make money off of Hedgie just trying to fill his request that he's already made there. So he's going to set the limit. With this one, I put Joe Retail. Joe Retail here, fan favorite. He sets his limit price for the 2,000 shares that he just received at $1,000. He just does this for no reason at all. He just sets it for $1,000 because he thinks stock ABC is going to continue to grow over the next year, and it's going to eventually be worth $1,000. So he sets his sell limit there at $1,000. That's leaving only 3,000 shares on that following Monday. 3,000 shares available on the market. Now, with that being available, doesn't mean they're actively on there. There's a lot of other investors and stuff out there that own these, and most, I would say, aren't active. They don't manage their accounts regularly, anything like that. So the shares are just sitting in their account, locked up, not going anywhere. And then comes the deadline. So the end of that 5 days is over now. Now it's all the way to the next Friday, and the broker wants their shares back. They're like, hey, you've had enough time. You haven't filled those orders yet. We need them now. So what happens? Mentally hodlers hodl. Forcing the Hedgie to buy anything that's available for sale. So they have to close out the position, and they have to buy those shares back. Now, what happens? They're buying everything they possibly can on the market, but like I said, a lot of people are holding their shares. A lot of people aren't paying attention. There's not a lot of active investors out there. So they're buying everything they can. And then we have Joe Retail over here who set their sell order for $1,000. If everything works out correctly and they buy and flip some of these shares and stuff like that, they'll end up having to get up to the $1,000 mark just to fill those orders, which entail, makes a nice tendy party for Joe Retail there, because he just sold all his shares again for $1,000 within just a matter of a week or so. Now, I got the 3 tips to slay the day. These are my ideas and opinions about how to possibly pull this off if you wanted to. Now, I am not a financial advisor. I'm not your financial advisor, so anything you do is on you, not on me. But before I wanted to get into those tips, I just kind of wanted to go over a little bit more in detail with the actual stock here. So, for example, with AMC right now, we're looking at it's about 1018. There's been a pretty strong push if you look here. There's been a few million shares traded over 5-minute intervals on AMC, which is pretty strong and heavy towards the downside. Now, when you go over and you look at the options that are expiring today, you actually have a pretty fair amount, 11,169 expiring at $10. So say, for example, this one right here, what is this? $11. There's 14,744. So if we take that 11,000, or what is it? 14,744, and we'll say on average it was $100 a contract they sold. There's $1.4 million worth of contracts expiring today at $11. So in no way, shape, or form is Joe Retail winning by that. Who is winning by that is Mr. Hedgie and Mr. Market Maker, depending on how many each they sold. But that's the only person that's winning in these situations here. And if you look, there's a lot of them pretty aggressive, all the way out to $29. There's almost 5,000 at $29 that expired today. That's not helping Joe Retail out at all. That's only helping Mr. Hedgie. Now these guys here, all of these guys, if they close in the money, they're trying to push really hard right now to get it below 10. But if all these close in the money, then 11,169 times the 100 shares each for each contract is 1,100,000 shares that somebody will have to buy and account for. That's a pretty significant mark there. So it's definitely in Mr. Hedgie's best interest to push the stock down. So they're willing to throw millions of dollars to try and push the stock below that $10. So that way they don't have to pay all those premiums. Even if it's 1 penny, 1 penny over the $10 can cause the stock to skyrocket, because if they have to exercise those contracts, then they have to come up with those stocks, meaning they'll have to buy those stocks back on Monday, and who knows what can happen on Monday. So the 3 tips to win at this game. Number 1, this is a share game. The idea is to hodl. That means no stop losses. When you set a stop loss, the hedgie's game is to try to push the stock down. They immediately push 1 million shares. They're going to try to drop it, 50 cents or so, to trigger a ton of those stop losses and create a reaction that continues to push the stock down. You do not want to have close stop losses on anything like this if you're playing the long game or the squeeze game. It doesn't make sense to have stop losses. It is a high risk and a high reward program. So in order to get the high reward, you have to put out the risk. And if you're doing stop losses, you're just hurting yourself. People call you paper hands, whatever. Stop losses are hurting you. If you're trying to squeeze, stop losses are hurting you. You're doing exactly what the hedgie wants you to do. You're setting stop losses. They sell 1 million shares. All your stop losses kick in. It drops another 50 cents. They can buy the 1 million shares right back, and it goes back up. No stop losses. It's a share game. No stop losses. Just remember that. Number 2, in the money calls versus out of the money calls. Whenever you are buying calls, it has a delta. And if you're buying it from the market maker, whatever the delta is, they generally will hedge with shares. So if you buy a 33 delta call, then generally they'll buy roughly 33 shares of the stock. And that's just kind of hedging your bets. Now with the hedgie, they don't hedge. They generally don't hedge when they're selling calls like that. So you buying far out of the money calls with a 20 delta, 10 delta, ideally in your mind you're thinking it's helping somehow push the stock up. It's really not. What's going to help push the stock up is buying in the money calls. In the money calls have the highest delta. So if you're buying it from a market maker, then they're going to have to buy those shares to account for it. So if you're buying something with an 80 delta, then every one of those calls you're buying, the market maker will pick up 80 shares. Now, hedgie will not. He won't pick up the shares. But what you are doing is you're creating more opportunity for yourself and less risk. Because if you're already in the money, then you have a higher probability of ending up in the money, and you're not exposing yourself to as much risk as, say, those $29 calls we were looking at there on AMC. Number 3, make your calls count. Now, with making your calls count, the reason that's important is because the whole idea behind this is exercising your calls on the Friday, or even letting them automatically exercise, forces whoever sold you the call to account for that stock. Now, if you're selling your calls back to them on Friday before close, you're just, selling them for whatever they're worth. Of course, you will save about, generally what broker you use. You might be saving $30 on those 100 shares, but whenever they buy it back from you, they don't have to account for those shares. So exercising it forces them, if they don't already own the shares, they haven't hedged themselves, then it forces them to buy 100 shares on the open market on the next opening day. Now, I think that's really important when you're trying to squeeze. Probably one of the most important ones out there. I hope that was informative. Actually, I think I made it a little faster than what I had planned on, but I appreciate you guys. Please like, subscribe. If you want any more content like this, just let me know, leave a comment, and I'll be happy to put something together for you. Thank you guys very much. Y'all have a great day.